This video starts the conversation on financial decision-making errors from our heuristics and biases. And the first one that we're going to start with is called the availability bias. Availability bias, if we think about it in general terms, we ask you the question, how many people die from shark attacks each year? So sharks. And then we'll ask you, during the same year, how many people die from coconuts or getting hit in the head with a coconut? And so people make their estimates, and usually sharks are 10 times the amount of people with coconuts getting killed by coconuts. In reality, 10 times, it's the opposite. 10 times as many people are killed by coconuts and getting hit in the head by a coconut than they are in a fatal shark attack. Okay, so what's going on here with the availability bias here? Well, freely available, easy to process information is more compelling. When you think about available information on shark attacks, what's more available on the news? Somebody gets hit in the head with a coconut and dies, or somebody gets bitten by a shark and dies? Of course, it's shark, and that's why we have these discrepancies, because our type 1 thinking immediately goes to, let's see, okay, yeah, I remember seeing sharks. I'm going to give that. There must be way more people getting killed by sharks than coconuts, because I never have heard of that in my world. So availability bias, once again, freely available, easy to process information is more compelling. In the world of stocks, availability bias. Once companies are included in the S&P 500, so the S&P 500 is one of the main indices in the United States, and it is a list of the top or the largest 500 stocks based in the United States. What that means, though, is these rankings shift over time. And when you get included into this group of 500, it goes on a lot of people's radars and becomes more available to people. And certainly if anybody's just investing in the index, yours becomes available through that passive investment strategy as well. So inclusion on this S&P 500 list, everything else equal. So your profits, your executive committee doesn't have to change. Nothing else changes except for your inclusion on this list. And it has been found on average, it boosts your returns by 3.5% a year. Nothing else happens. 3.5% a year just for being on the list, being available. So more readily available, better returns. Next, we're going to go back and revisit this diversification heuristic that we've learned about a couple of videos ago. And we were talking about buffets, right? Looking at trying to eat everything and how that's not a bad thing, except for maybe your waist. But here in stocks, when we're talking about financial decision making, diversification heuristics, we're talking about options in our retirement accounts. And what ends up happening here is whatever's available, we tend to want to take a little bit of everything. So what that means is if we have a stock fund, a bond fund, a bond fund, a bond fund available, what we end up doing is we say, okay, well, I don't want to miss out on anything, so just give me a 20%, 20%, 20% of everything, and then we just want 20% of all the pieces. But what ends up happening is we have a portfolio that is 40% stocks and 60% bonds. And if we are in our 20s then that's not going to be the best asset allocation strategy for you. I know everyone's different, but I can tell you that 40% in stocks and 60% in bonds, if you are going to invest for the next 40 years before retirement, is not the ultimate or optimal situation. But because we took a little bit of everything, it led us now into a bad situation. So we looked at this and we actually tested this, and wasn't me. This was Shlomo Bernard St. Dick Thaler looked at this and put it in an experimental lab. What they did here is they had 3 different funds, and they just wanted to test this. Do people actually do this, or do they gravitate towards their actual preferences? Can they override it? Just say, I don't need to have everything here. I just need to match my optimal asset allocation. So we have a fund here, and the 3 funds. One was a stock fund, other one was a bond fund, and we had a balanced fund as well, which is a 50-50 split between stocks and bonds. Okay, and then bond fund. And we had 3 different groups. So group 1, they were offered a stock fund and a bond fund. Group 2 were offered a stock fund and a balanced fund. And group 3 was balanced fund and bond fund. And so they were analyzing, how did everybody behave here? So in group 1, they noticed that the overall asset allocation range could have been from 100% stocks all the way down to 0% stocks and 100% bonds. That's our range here. So the range was 0 to 100. And they found that the average allocation was 54%. For group 2, the range here, because they had stock fund and a balanced fund, the most conservative they could be was all balanced, so 50% stocks, but they could also be all the way up to 100% stocks if they chose only the stock fund. So there's 50 to 100, and their average allocation was 73%. Now, mind you, these groups are similar characteristics, so similar age, should have this fairly similar asset allocation agenda in mind. And then we have the conservative group here, group 3, that could be between 0 and 50% stocks. And once again, they had 35%. What we call this is, we're talking about diversification, where you take a little bit of everything, and you can see here there is split down the middle with a slight variation up. So halfway is 50, this is slightly higher. Same thing here, we've got an anchoring towards the middle there, and it was slight adjustment down by 2%. And then here, there was a little bit of pull, trying to get pulled all the way up to 35%, but that's only 10% higher than the middle ground of choosing half of each. And what this is called is naive diversification. When you split all of your assets that are available, that is what we would define as totally naive diversification. And this is a part of our diversification heuristic in the world of retirement investing. And if you think that if you are, this is just for the average investor or the dumb money, guess again, there's a lot of people who actually fall for this, and we have to be highly aware of this when we're making our decisions. I've got a quote here that says, when I was making my retirement account decision, I visualized my grief if the stock market went way up and I wasn't in it, or if it went way down and I was completely in it. My intention was to minimize my future regret. So I split my contributions 50-50 between bonds and equities. Does that sound like maybe a quote by average Mr. and Mrs. Smith in the United States? Well, this quote was from Harry Markowitz, who might not ring any bells, except for he was the official starter of the capital asset pricing model, or this efficient frontier market that we use in our classical finance. So he even admits to doing naive diversification. So if you feel that way, you are not alone. All right, as we continue on our conversation, we're going to stop with that and move forward with some more points that affect our financial decision making, and we'll keep rolling along. See you on that next video. Thanks for watching, everyone.